Good afternoon. Thanks for joining us today. We have Tantalus presenting, which is very exciting because they just listed yesterday on the TSXV under the ticker GRID. It was a great day to list because the stock did really well. So before we get started, I will remind everyone that there will contain forward-looking statements in this presentation. If you'd like to know more about those, you can find them on the company's presentation on their website, which has been just updated for this webinar. And there will be a Q&A section at the end. You can input your questions in the Q&A box at the bottom, and we'll get to those towards the end of the segment. And as some of you may know, Tantalus is a smart grid technology company that transforms aging one-way grids into future-proof multi-directional grids. And here to tell you more about what that means is Peter Londa, CEO. Thanks for joining us today, Peter.
Deborah, thanks for hosting and allocating time to support the webinar today. And good morning to everybody who's participating. Thank you.
Well, I think it's a really interesting space, being in sustainability, ESG, are thematically very on trend, and seems like an exciting time for the company. So can't wait to hear more about it.
Great, thanks. Yeah, it's been an exciting several months for us as we've prepared for and ultimately executed on our transition to the public markets. And witnessing the first couple of trades go through yesterday was somewhat surreal experience for me at a personal level, but for our team, just a terrific testament to an unbelievable set of people in our organization that have worked so hard to help utilities transition their grids, and in conjunction with that, be able to tell our story and provide an overview of our sector and what we're trying to do and how we're trying to help the utility industry to a broader set of investors. So it's a privilege and a pleasure to be here. So thank you.
Yeah, sorry, I was just going to say, why don't you tell us a little bit about yourself and the company, get started on the presentation?
Yeah, sure. Thanks, Deborah. So I'll click through a few of the disclaimer slides, just referencing materials that we're providing, but thank you. So brief introduction on my background. Again, my name is Peter Londa. I've got the privilege of serving as president and CEO of Tantalus. I've been a part of our team since 2014. And I joined the company after serving as CEO of another smart grid company, similar space, helping utilities leverage technology to improve their efficiencies and reliability. But I was CEO of a company called BPL Global. That business was privately held. And a little different than Tantalus, we ultimately decided to sell our business to a behemoth public company called Danaher Corporation in the United States. But have been focused in on this sector dating back to the 2005 timeframe. So over 15 years at this point. Started my career actually in investment banking, and from an educational perspective, hold both a law degree and an MBA here in the U.S. I am based in the U.S. While our company is headquartered out in Burnaby. I'm also privileged to just briefly introduce a few other members of our management team who are listening in today and available to support Q&A to the extent there are questions that I can't cover. But we've got George Resnick, who is our CFO, on the phone today. George is a relatively new addition to our team, a career veteran CFO of technology, publicly traded companies in Canada. He's served on a number of different executive leadership teams over the last 2 decades of publicly traded companies. I also have Dermot O'Leary on the phone, who's our Chief Operating Officer. Dermot and I actually were partners and work together at BPL Global. So our time together from an execution perspective and a management team perspective go back for an extended period of time. In addition, we have Mike Grandis, our general counsel, and Mike Julian, our EVP of sales. Beyond the management team, which is a fairly robust collection of individuals, almost all of us have been a part of the same team now for an extended period of time. Here at Tantalus, we're ultimately led by our chair of our board of directors, a woman named Laura Formusa. And within the utility industry, Laura is an absolute celebrity. She's among the most accomplished female executives in the North American utility industry, where she served as CEO of Hydro One, one of the largest utilities in Canada. She's based in Toronto and been a part of our organization now for several years and serves as a chair for the last 3. So it's a privilege to work under her and continue to have access to her guidance and expertise. We also have come into the market with a collection of really robust investors, some of whom have continued to participate in our most recent financing to help us transition to the capital markets. Yesterday, Pender Fund and Dave Barr and his team have been longstanding investors in our company, and it's been a real privilege to work with him over the years and have access to someone like him who's so acutely aware of capital markets and drivers for small cap tech companies. So it's a collection of people that we think puts us in an extremely solid position as we make this transition into the capital markets and ultimately position Tantalus for accelerated growth in conjunction with being publicly traded. So sorry to be a little long-winded on our background and introduction of our team, but we think that's one of the most critical assets associated with the company in terms of our management team, our board, and obviously the institutional investors that are already supporters of the company. With that said, I don't know how familiar many of you are with the electric utility industry. If similar to me, several years ago, before I even got into this space, I never really thought about my electric utility company or thought about electricity until I would go to turn the lights on and find out there was no power in my house. As the world has evolved and as our homes and buildings have become more automated, with the proliferation of broadband and smart appliances, what we find today confronting the utility are a series of and a collection of really secular trends and drivers that are forcing the utility industry to change and to adopt technology at an accelerated rate from what they typically have done. And so to that end, I'd start by highlighting when most people think about their utility, it's when they ultimately do not have services and or they've lost power. Sometimes that comes from a massive storm, which we've unfortunately seen here in our area of the region on a more frequent basis. When the lights go out, it means we are in the dark, no pun intended. And as it relates to today's environment with COVID-19, that has a cascading impact with so many children being educated at home and so many of us running companies or a part of companies where people are still working remotely. And if you just think about this call, if your power goes out, you lose access to this discussion. That becomes problematic and very expensive and disruptive to what you're doing every day. So utilities are acutely aware of this, and they consistently are investing in infrastructure to try to not only be more responsive when the power goes out, but to leverage tools and technology to predict when those outages may occur and where they have vulnerability. In terms of how outages are impacting consumers, all of us on the phone as consumers of electricity, right, we are quickly adopting and deploying smarter appliances inside our home. The advent of smart thermostats has been around for a while. If you're like me, I have Nest thermostats. I control the temperature when I'm either inside the house from my phone, or even more importantly, if I've left the house and forgot to turn down the heat or adjusted the air conditioning during the summer months. So we are starting to have the power of control through our iPhones or other smart appliances. As we want to maintain reliability at our homes or in our buildings, we're also seeing the quick adoption of distributed energy resources. That's what DER stands for, and you'll see that reference in our presentation throughout today and through the literature about our organization. But what we're witnessing is the price points for rooftop solar and even things like battery storage or power walls. Those price points are coming down. As they come down, they become more affordable. We see it in the United States. We're seeing it in Canada and the Caribbean Basin, where there are tax incentives or initiatives at a state level or provincial level to force the adoption of distributed resources and really alter how people access supply of electricity. We're also witnessing the adoption of electric vehicles, and that's obviously gotten a lot of attention through the capital markets over the last several years, with some individuals who are promoting electric vehicles on a daily basis. And if you're like me and a sports fan, I enjoyed watching the Super Bowl. It wasn't a great game on Sunday from my perspective. I didn't really have a hat in either ring. But with the exception of the fact that defensive coordinator of the Buccaneers came from my hometown, so I was cheering for him individually. Right? But the best part about the Super Bowl, in my opinion, was one of the commercials on CBS, which was the network I was watching, with Will Ferrell, a comedian, an actor, that was doing an advertisement for General Motors, and it was the race for the adoption of electric vehicles of the United States against Norway. It was the first time I've seen any real effort by one of the largest automobile manufacturers in North America begin a push to advertise for the adoption and production of electric vehicles. We'll talk a little bit about that momentarily as well. But it's the advent and the adoption of EVs, of solar, and of power walls and smart appliances that are impacting our consumption and our expectations of the utility company. That has a cascading impact on the utility infrastructure. And you'll see on the bottom left, the grid has to change. The grid was designed 100 years ago, if not more, right, for the one-way flow of electricity from a centralized source of generation, typically coal-fired plants, nuclear plants, some hydro, obviously up in Canada. It's a little bit cleaner, right? But a one-way flow of electricity from that central source of generation down to substations, and from substations like a spider web out to our homes, our premises, or the buildings that we rely on every day. As people adopt electric vehicles, solar panels, storage, as utilities start to look to offset power plants from a central source of generation, we're witnessing the proliferation of distributed energy resources. Those sources of generation are starting to show up behind the substation, closer to or even at the home, behind the electric meter. And what that's forcing utilities to do is to start planning for and being prepared for what we refer to as a multi-directional grid, meaning a grid that has sources of supply at the location of demand, or sources of supply where the grid wasn't originally designed to support. And as electricity and electrons flow in multiple directions, and you have sources of supply, some of which are variable, like solar panels, that can create significant reliability issues and efficiency issues for the utility. So when you think about the disruption of outages today, the change in behavior of all of us in terms of how we look to automate our homes or find cleaner sources of power, the impact that has on the grid, fundamentally, the utility business model is under pressure. We've seen a decline in consumption over the past several decades. It's starting to flatten. With the advent of Bitcoin, maybe this curve starts to change upward relative to how much energy actually Bitcoin and mining organizations consume. But the utility model is under pressure. Revenue profiles can be compressed. Sometimes that gets offset by higher rates. Higher rates dictate what we do individually and motivate us to buy solar panels or smarter appliances so we consume less. So this is a dynamic time for the utilities. In addition to all these issues, the utility also faces the longstanding issue of squirrels running wild on their lines. And we have some funny stories about utility linemen and women. I wouldn't necessarily think of utilities having a great sense of humor, but we have the old adage story of the throwdown squirrel. And the throwdown squirrel is an electrocuted squirrel that's bitten into a line and disrupted power at someone's home. And when people come out and they start yelling at their utility linemen and linewomen to complain about electricity being out, they'll drop the throwdown squirrel and say, sorry, it was the squirrel. And great stories about how people's perspectives change in empathy for now the dead squirrel. So the squirrels are running wild, and we're trying to think through how we can help the utility address it. In terms of some recent news, even today, we noticed that, and you may have seen some of this in Canada as well as the US, right? But because of COVID-19, there are a significant number of people that are struggling to pay bills, and that transpires into power bills. And so the utilities in many states are required now to continue to maintain power to people who are falling behind in paying their bills. That's starting to pile up. It's a national emergency and a state level emergency in most circumstances here in the US, where the vast majority of the utilities are that we support. And even today, the NRECA, which is the National Rural Electric Cooperative Association, that's a mouthful, but the NRECA is a membership and an organization that represents rural electric co-ops. We are an affiliate member to their organization. And even in today's press, there was a reference that came out with the NRECA pushing the Biden administration to allocate up to $10 billion to the utility industry to help low-income families pay their bill and maintain vital services in the home so that their kids can have power to hopefully continue to get educated to the extent they're not able to go to school. How that ties to then infrastructure. We've seen in the last several weeks, two states, the state of Washington and California, come out and release plans to overhaul the way in which vehicles will be sold in their states. And if you think about it, not too far from our headquarters in Vancouver, British Columbia, the entire state of Washington has a mandate to eliminate the sale of gasoline and diesel vehicles by 2030. That's less than 10 years away. That is not far, and that has a cascading impact on how the utility prepares for it. California is one of the largest states in the United States. Right? Similarly, massive initiative. We've seen that, and I sort of was tongue-in-cheek about the Super Bowl, but last week General Motors came out and made one of the largest statements towards the adoption of electric vehicles we've seen in the elimination of producing gas and diesel vehicles by 2035. Again, that's only 15 years away. And while you could say, how does that impact the utility industry? We'll talk about that. But it means the utilities have to start planning today for vehicles showing up and either consuming or potentially discharging sources of power through batteries that they never expected. Within his first 7 days of being in the White House, President Biden issued an executive order tied to getting the United States back on track in terms of investing in and prioritizing climate change. He's referenced this as a national emergency. And embedded in that climate change and executive order is an effort to decarbonize the entire power industry in the United States. It is an ambitious plan. And how we've seen that manifest at the utility industry is an organization like the American Public Power Authority, which represents almost 3,000 utilities across the United States. They have responded by mapping out a plan for utilities, distribution utilities, to decarbonize their efforts and their grids by 2050. That's a massive investment in infrastructure. So as utilities are dealing with these changing dynamics and these headlines that are coming at them, and a change in the focus at the administrative level, and a change in the way we all are consuming electricity, it's forcing utilities to find long-term partnerships with technology vendors that can help them prepare for and ultimately plan for these changing dynamics. And that's where Tantalus, our business, comes into play. We have a very, very rich history in supporting electric utilities. And while yesterday was our first day trading on the venture exchange, our company actually dates back to 1989. That's when we were founded. I'm not the founder. I was recruited in by the board, as I'd referenced, in 2014. But the company in 1989 was founded with the idea of helping utilities access data and leveraging that data to ultimately improve their core operations. Within that, as our business has evolved, we became dedicated to a sector of the utility industry in North America referred to as public power utilities and electric cooperative utilities. We'll talk a moment about the market size associated with that, but 100% of our deployments in our technology are geared to a very specific segment of the utility market today. And because of that, we refer to ourselves as purpose-built and purpose-driven. Everything that we do has a purpose as it relates to helping these utilities. In conjunction with that, we deploy and develop a lot of technology. One of the key attributes and differentiators of our solution versus some much larger organizations that are similarly publicly traded in the United States and over in Europe is flexibility, is allowing utilities to invest in infrastructure and technology today that not only leverages existing assets that they've already deployed and increases the return on investment of those devices or those investments, but also plan for and lay the foundation and platform for the change that's coming with the proliferation of distributed energy resources. We do all of that through establishing incredibly long-term relationships with utilities. As an example, I had the benefit of being on the phone earlier this week with a utility in Ontario, up in Canada. They've been a utility partner of ours for 16 years. They deployed the first generation of our technology 16 years ago, which is still in the field. We still support it, and it's still functioning incredibly reliably and still producing value. But that utility and their CEO commented to members of our executive team on Monday that as he starts thinking about the next 15 and 20 years, he hasn't witnessed a significant adoption of electric vehicles and rooftop solar, but he's planning for it. And so as he thinks about upgrading his investment and making multi-million-dollar decisions, his biggest issue that he's trying to solve is making the right decision to buy technology today that can be in the field for the next 15 years, that provides his team with the flexibility to change and evolve as his dynamics change, as his business model needs to change. And that's the type of relationship that we build with utilities. Our systems are co-created and co-designed with the utilities we support. And while the utility industry probably isn't the sexiest adopter of technology, and they can be pretty difficult in terms of securing as a customer, our sales cycle can be pretty long. Once we lock in with a utility, we're there for multiple decades, and it gives us the opportunity to continue to iterate our technology, to continue to sell new services and solutions, and to continue to drive revenue out of these longstanding relationships. So let's talk briefly about what we actually do. How do we leverage technology to help transform electric distribution grids? The first thing that we do, and ties to the heritage 30 years ago when we were founded, is we are able to deploy with our own technology. Some of these are devices. You'll see these images. I'll use my mouse. Apologies. But some of this is our own intellectual property that we build with a contract manufacturer and then sell to deploy a very robust communications network that's proprietary to the utility, meaning a network that they can leverage for their own purposes. As our system, our communications network has evolved over the years, we are able to support a network of things, or another way of describing that is an Internet of Things. Internet not in terms of consumer access to the network, but allowing IP addressable devices to coordinate and communicate with each other as one unified network. Once we proliferate and build a communications network, we then embed, and this is part of our IP as well, we actually design, build, and sell an edge computing module that gets integrated under the glass of a meter. We don't build meters, big distinction from some of our peers. But our edge computing module goes under the glass of a meter, something like this device, or legacy devices called ERTs, encoded receiver transmitters. We're also taking the same technology and the same edge computing capability, and we're embedding it into other smart devices, such as LED streetlight fixtures, where we have a partner that's helping automate street and security lighting managed by utilities. We have our own intellectual property around load control switches, and this is really the path for us to expand into the home and help the utility command, control, and track distributed energy resources like an electric vehicle or like solar panels. And we have a series of partnerships where we're also embedding our communications and edge computing capabilities into distribution automation equipment. So at a very high level, we build out a communications network, and then we help connect devices to that network, all of which have a Linux-based edge computing platform that drives data and drives analysis at each endpoint. Once we access the data from these devices, connected devices, we then have a suite of software solutions. It's enterprise software that's deployed by the utility and for the utility to not only visualize what's happening, accessing that data, but then as we get smarter about the data that we're collecting, how do we actually build and deliver predictive analytics software tools and professional services to help the utilities optimize the performance of their network and extract as much value from the physical devices, meters, load control switches, distribution automation equipment, but maximize the return on investment in that infrastructure. And so our revenue profile is a mix of hardware and software, as well as professional services. As we continue to scale our business, and part of the process of going public to access additional capital and diversify our access to the investor community, it's with the intent of leveraging our load control switch and some of our existing software to truly help the utility transform in anticipation of electric vehicles and other DER showing up in their distribution grids, and or proactively going out and engaging with their customers to motivate the adoption of distributed energy resources. So our technology really ties to a set of connected devices and then a suite of software and services. And so as you potentially learn more about our business and see some of our filings and look at our historical financials, which are now posted through CDAR in conjunction with going public, we disaggregate our revenue profile into two segments, one of which is the hardware, the connected devices, and the second of which we refer to as utility applications, which is a bundling of our software and our professional services. So we are a blended business. And to that extent, the hardware ultimately leads us to access data that drives the value of our software. What we do today is establishing the platform and the foundation for utilities to capitalize on the adoption of distributed energy resources. And while the image here is somewhat futuristic in terms of a home that would have smart appliances such as a hot water heater or electric vehicles, storage, or solar, what we're working towards is putting the device, our intellectual property, on the side of the home in partnership with the utility, connected to a high-speed network, fiber or otherwise, that can coordinate and integrate and ultimately command and control a number of these devices as they show up. And so I think unlike some other organizations that are talking a little bit more hypothetically about the adoption of DERs and trying to time when that will happen, we actually are already actively deploying the infrastructure and building the tools to support this proliferation. So I'm not betting on, and we're not betting on when this happens. We're betting on the here and now of providing the flexibility for the utility to start investing in anticipation of what's to come. In terms of our market size, this is a little US centric, my apologies, but there are roughly 3,000 electric utilities that we are actively pursuing. They represent over 40 million endpoints or homes across the United States today. We also focus on the Caribbean Basin, where we have an existing footprint, and up on the eastern portions of Canada, Ontario, New Brunswick, and the Nova Scotia area today. As we think about how our focus and our purpose tie to near-term prosperity of our organization, a couple of metrics for you all. Today, we support 185 utilities across Canada, the US, and the Caribbean. So we actually have scale. Within that, over the last 6 years, we've seen a compounded annual growth rate of the number of utilities we support. This translates to roughly 20 new utilities each year selecting Tantalus as their trusted long-term technology partner. And we're very good at continuing to build the user community. Our goal is very much Trojan horse. Secure the relationship with the utility, get them to start investing in the communications infrastructure and the hardware, bring in the cavalry with software and services over a multi-year, multi-decade relationship. Within our user community of 185 utilities, over 80 of those utilities are referred to as multi-commodity utilities, meaning utilities that are not only responsible for the delivery of electricity, but also responsible for the delivery of water and or gas. And as we think about growth of our business, we're already entrenched with existing infrastructure to help the water side and or the gas side of a growing component of our overall user community. As I'd mentioned, it's kind of hard to get utilities, but once we do, almost 99% of the time, they are with us for at least 15 years to drive revenue. To that end, as well as data and growth, today we collect out of our user community 30 billion meter reads. What that means is 30 billion data points each year on the consumption and the behavior patterns of consumers and buildings across these utilities footprints. We're just starting to scratch the surface on how we access that data and convert that into predictive analytics software tools to drive more revenue. And I'd also highlight within the existing customer base, there's roughly 1.5 million endpoints, devices that we have not yet deployed. And while not included in this presentation, on average, for every endpoint deployed, bundled, hardware, software, services, we generate about $125 per endpoint. So if you take $125 per endpoint times roughly 1.5 million endpoints to be deployed within our captured accounts, we have almost $200 million USD of revenue visibility within our customer base before we sell anything else beyond what we do today. That's translating into some financial success as well. We've now delivered positive EBITDA for 4 consecutive years, and roughly 30% of our revenue profile comes from software and services as we continue to proliferate and invest in the expansion of what we can do based on the data we collect. Speeding up a little bit from a financial perspective, some of this is already available in much more granular detail. I would highlight 2 things for you. The first is the last 3 years, 17, 18, and 19, are reported under IFRS. Prior to going public, we reported in US GAAP. Some of our largest shareholders were US venture capital firms and or US institutions. And so the historical data, 2013 to 2016 on this slide, are still under US GAAP. Slight differences in terms of accounting principles. I'd also highlight that we report in US dollars. That's our functional currency, partly because the vast majority of the utilities we support today are in the US. Um, as you can see, we've continued to expand our EBITDA contribution margin each year. As we gain scale, as our revenue profile grows, we've got a team in place that can find and has identified operating leverage in our business to continue to scale our profitability. As we think about top line growth, and in conjunction with going public, there are a couple of very key areas of strategic growth for us, some highlighted here. I'll point to a few. In the immediate term, we will accelerate our investment in R&D to bring forward predictive analytics software tools, all of which help not only improve the value of the investment that utilities are making in our infrastructure, our devices, but also continuing to drive additional contributions in revenue from software and professional services, driving that recurring revenue base out of the existing customers that we support. We've also got the foundation and the platform to help utilities prepare for longer term the proliferation of distributed energy resources, as well as smarter community initiatives like the conversion of legacy and old antiquated streetlights that are very expensive to maintain and consume a significant amount of electricity. The utility segment we support, public power in particular, they're responsible for the maintenance of that street lighting and security lighting infrastructure. They're responsible for delivering power without really getting paid for it. So how do we help them do that more efficiently? By leveraging the communications network and the computing and the software capability that we deliver today. I'd mentioned almost 80 utilities that we support today, or over 80 utilities also have water departments. We are quickly expanding the number of water meters that we can communicate and connect to. From that, we'll extract data and build true tools for the utility, in particular, how to identify where there are water leaks in their water distribution system, how to pinpoint it, find it, isolate it, and fix it. It's an immediate opportunity for us to expand our total addressable market opportunity, and we'll look to both do that organically and in conjunction with targeted partnerships or acquisition. And then lastly, we're looking to expand and ultimately diversify our regional focus. BPO Global, where I was before, in highlighting my background, we supported, I think, almost 95 of the 100 largest utilities in the world: China, Africa, Southeast Asia, North America, Europe. That can be very challenging to manage as a smaller organization. Our COO, Dermot O'Leary, who I referenced, and myself, we have some experience doing that and building and expanding internationally. We'll seek to do that on a targeted basis as we can identify either acquisitions that add to our technology, but also expand our regional focus, or through strategic partnerships. So those are some of the key areas where we're looking to access capital and leverage the currency of a publicly traded stock to help accelerate the revenue profile of the company. In terms of valuation metrics, we raised a concurrent financing to support our process to go public yesterday. The valuation metrics that were applied dated back to the September and October timeframe. Our comps have remained the same, but I think with the trade winds of the Biden administration here in the US, the expanded adoption of electric vehicles, and frankly, the infrastructure investments that are coming through stimulus packages in Canada, the US, and the Caribbean Basin, right? There's been a decent uplift in valuation metrics for our sector. And so hopefully we get some of those tailwinds as well as we triangulate and migrate into the capital markets. In terms of the cap table, as of yesterday when we went public, we had set a share price of $2.25 Canadian. We had roughly 38.9 million basic shares outstanding. A portion of that controlling interest went to our legacy shareholders, and then obviously an allocation of shares to the capital pool company, RiseTech Capital, who we acquired to access the public markets. In conjunction with raising money, we leveraged the teams of Canaccord Genuity, Cormark, and PI Financial, three terrific investment banks up north in Canada. And in conjunction with that, provided them with some broker warrants at the strike price of $2.25 as we went into the market. We hope the totality of that creates a compelling investment thesis as we continue to try to improve the visibility of our organization in the capital markets. And what I'd say in summary is our goal, our vision is to help utilities prepare for the transformation of their grids while simultaneously reducing the environmental impact that they have, while also providing better services to you and me from a societal perspective. We think we've got a substantial opportunity, not only with what we do today, but what's absolutely coming. We're proven in our ability to deliver technology and support utilities with a growing and thriving user community of over 185 utilities today. We've got some identified strategic growth initiatives where we'll be very disciplined on how we execute, but a path to do that through both partnership, R&D, and acquisition. And we've compiled a team that's had the opportunity to work together now for several years, some of us for over 10 years together, and to start really thinking through how to drive efficiency in the business. And if we do this well along the way, not only can we create shareholder value, but we'll hopefully also be able to save a few more squirrels along the way, or at least get some throwdown squirrels for our utility linemen and linewomen that we support. With that, Deborah, I see a couple questions that came in, so I'll take a break and open up for Q&A.
So let's kick it off talking a little bit about your margin profile, which is a little bit lower than you put than the comms table slide you put up. I know you talked about a few initiatives that you're working on. How do you address that differential margin, and what would be your long-term margin?
Yeah, I'll go back to the comps page to reflect that. So, our gross margin is in the mid 40s today. Our EBITDA margin is obviously not at scale yet at roughly 7%. I hope I'm not making everybody nauseous by flipping through slides, but you'll see it here. From a gross margin perspective, or gross profit perspective, we're pretty comparable, and in many circumstances above our comps. On the EBITDA side of things, where we're looking to scale is we're continuing to invest in the business. We have historically been resource constrained, meaning if we had the flexibility to put more money to work through headcount or through R&D initiatives, we could accelerate the growth of the business. We haven't had a lot of that flexibility, and we've had to fund a lot of our operations based on cash flow from operations itself. That's created a discipline in our organization, so that's a good thing. But it's also handicapped our growth a little bit. So a few of the key initiatives that we're working on, Deborah, is to continue to increase the contribution of revenue from software and professional services. I'll give you a few specific examples. When I joined the company, and this isn't about me, Pete Londa, this is about our team, but when I joined the business in 2014, almost 90% of the revenue came from the sale of hardware. And the gross margins for the business were in the low 30 percentile, if not slightly below. We've done two things in reconstituting the management team and bringing some fresh perspective into the business. The first is we've driven aggressively to increase software and services, where that represents now 30% of our revenue profile. As we continue to expand our software capabilities, based on all the data that we're collecting from the hardware, we anticipate seeing an increased contribution of revenue from software and services, which by default will increase gross margin, with a good chunk of that increased gross margin dropping through to the EBITDA line. The second thing we're doing is we've been pretty aggressive in trying to think consistently how we improve the design of our hardware, and by definition then decreasing the bill of materials and the actual internal cost of goods sold. And we've been pretty effective on that as well. So I think there'll be a couple of initiatives at the cost of goods sold level and the revenue profile level that will improve gross margin, which carries forward. Within OpEx, there are a few other things that we're doing with the addition of George Resnick as CFO. We'll have leadership at this point that can absolutely think through and be successful, most importantly, in deploying and rolling out a more comprehensive ERP system. so that we can get better visibility on how things are moving through our pipeline, how that translates into inventory builds and managing our supply chain. And in conjunction with that, driving margin, operating leverage out of the OpEx side of the income statement. So those are some of the things that we're gearing towards. In my opinion, Tantalus, as we scale, can get to a 15 to 17% EBITDA margin. That's our internal target. I think some of that will be done through revenue mix. Some of it will be done by just gaining more operating leverage in the business. Lastly, not to beat a dead horse, but we'd also highlight we don't spend a lot on CapEx. A lot of our manufacturing is outsourced to a third-party contract manufacturer. So we're not a CapEx intensive business. So as a result of that, we should see some free-flowing cash from gross margin down to EBITDA margin as we continue to scale. Hope that answered your question.
Yeah, I have some follow-up ones though. So that 15 to 17% target EBITDA margin that you referenced, is that planned through totally organic growth, or are you going to require an acquisition to get to that level?
Yeah, so I think there's I'm learning the new restrictions as being CEO of public company versus private company. But Deborah, I think it'll be a combination of both. Within our targeted growth areas, we have some initiatives that will be organic, continuing to drive efficiency within our own organization. We have ballpark 70-ish employees that are dedicated to the development and delivery of our technology today. Those resources will continue to churn and execute on engineering efforts, product roadmap initiatives to expand the software side of the business, and or drive cost out of our hardware. Some of it's organic, but we've also got a number of existing partnerships that tie to targeted acquisition opportunities to diversify our product portfolio, expand the capabilities that we offer, not only at the electric side, but also to the water and gas side of the utilities we support. And then we're also starting to think about how we identify a few potential targets to diversify geographically. So it'll be, we've got a strategic plan that includes both organic initiatives as well as some targeted acquisitions that we hopefully can execute. I'd say from a management perspective, we have much more control on what we can do organically. We'll do everything we can, I think, where we identify strategic opportunities to accelerate growth through acquisition. We'll do our best to try to entice and align those transactions, but we can influence decision making. We can't control other people's decision making. But to that end, our team has a pretty rich track record of executing acquisitions, not necessarily at Tantalus, because that hasn't been part of our history. But it's certainly at BPL Global, where I was former CEO, and a number of our team members joined me. We got the band back together here at Tantalus. We scaled BPL Global through 5 acquisitions, both domestically in the United States and internationally.
Well, it's important to have that experience under your belt. So you were talking about your revenue splits, about 70%, 30% hardware to SaaS. When you're talking about that target EBITDA margin, where do those percentages fall once you achieve there? Like, what's the ideal mix? I guess the best way to ask the question.
Yeah, I think some of it's a function of how things evolve, and I think our approach is to identify need. Well, let me backtrack. We've got an unbelievable resource and asset in the utilities that we support today. And I referenced in the presentation, and I hope it wasn't lost on people, the concept of co-created and co-designed. We gather every year through surveys the top 5 to 10 priorities that utilities, our customers, have. That gives us great insight as to what their biggest issues are, what their biggest challenges are, and how they think about resolving them. From there, we'll prioritize how we allocate our capital and our resources to scale. I think the opportunity for us to witness a continued blend of hardware to software of potentially 60-40, 50-50 is not unrealistic. But with that said, the hardware is a very important component to the utility industry because they need the physical assets deployed. Those devices then drive software revenue. It's not too dissimilar to the iPhone. You got to have one of these in your hand. We go out and spend $1,000 to upgrade to the latest one because of an incremental camera. I'm guilty of it too, right? Or I'll opt into another contract with a cellular provider. But it's the hardware that ultimately leads to then the software revenue. So I think we'll always see and drive towards improved margins on the hardware side, but it'll be a material percentage of our revenue mix. And I could see a 40-60 type split over time, especially depending on how we prioritize some of the paths to scale the business. Some of the businesses that we're familiar with and would evaluate in terms of pursuing to expand our opportunities quickly. Some are a little bit more hardware centric today, some are a little bit more software centric.
Sure. And can you give us an idea of what the gross margin is on hardware versus software as a service?
Yeah, the details of it. I don't mean to be tongue in cheek back to you. The details of it are in our disclosed financials, so I don't have them off the top of my head. Order of magnitude, though, we're blended gross margins on the hardware side in the upper 30s percentile, and then on the software side, our gross margin is what you would expect from a software company. It's in the 90th percentile. Our professional services are actually field service expertise. It's not knuckle dragging installation partners or installation folks. So our blended gross margin on the professional services side is in the 50th percentile, somewhere in that neighborhood. George is on the phone and he could probably give you the much more specific details, but that'll give you order map. It's sort of shaping for purposes of today. And then obviously we disaggregate the gross margin based on the hardware side and the software services side in our financial reporting. And sorry, Deborah, I don't have those specific
No, it's okay.
but that's order of magnitude.
I know who's asking the question, so I could always follow up with them later. So you reference 1.5 million devices that can be connected within your existing customer base. That's about a 200 million revenue potential. What's the current penetration today?
So within the 185 utilities we support today, we've deployed, I think in the aggregate, almost 2.5 million endpoints, a little bit more than that at this point. So, we're some utilities are fully deployed. Other utilities that are relatively new to our user community or have recently selected us are just starting to ramp up. So that we see utilities, some that tie to sort of the reputation of their location. We've got a couple of utilities in Texas that take the don't mess with Texas mentality, and they're going to whip and replace and upgrade their entire infrastructure in 12 months, and they need the partner to do it. And then we see other places that move a little bit more conservatively, either because of capital constraints or just access to resources. There's an example, the Mojave, a utility in the Mojave Desert. They're massively capital constrained. It covers an Indian reservation. Their deployment plan is probably 7 to 8 years. We'll support both. And so we see some utilities that are moving very quickly. We see some utilities that are moving over a period of time. That term of flexibility is part and parcel to differentiate ourselves against some of the much larger peers. So of the total user community represents a little over 4 million meters. About 2.6 million of those have already been deployed and or upgraded.
Okay, and given what you just said, is it realistic to get to 100% penetration on those 1.5 million devices, or what percentage would you think is realistic?
Yeah, so over time, absolutely. We have a collection of utilities that are leveraging some legacy one-way paging devices that may have been deployed 15, 20 years ago. And we relied on, if you think about meter reading, when I grew up, there was an individual who physically came to the side of my parents' home, pen and paper in hand, wrote down a number off the meter, went to the next house and the next house. It was a manually intensive process. Believe it or not, there's still a large number of utilities in the United States, and especially when you get into Canada and then the Caribbean Basin, who still do it that way, manual. Some utilities started to invest in what's referred to as automated meter reading, AMR, with a drive-by system. Instead of having someone physically walk down the block and go house to house, they drive a truck, and that truck has collectors embedded in the back of it. It's listening for paging signals from some metering infrastructure. We're unique in helping utilities eliminate the truck, establish a communications network that can read and listen for the paging signals from this legacy infrastructure, and then pinpoint how to upgrade it. So not necessarily direct to your question, I hope we're never at 100% penetration, because that means we're struggling to then find new utilities to deploy. Our goal is consistently add new utilities every year while the existing utilities continue to deploy, add more endpoints available to us over time, because by definition, that then increases our visibility into planning our business and planning for financial results that we'll report quarter after quarter. But I believe 100% of those 1.5 million endpoints will be deployed. It's just a function of timing.
Got it. And let's talk about customer concentration. You referenced 185 plus utility customers. What percentage of your revenue comes from the top 10 or top 25 of these customers?
Yeah, so fortunately, when we disaggregate that each year, the mix of customers changes, meaning the top 10 revenue customers in 2019 are different than the top 10 customers in 2020 or 2018 or in the future. The reason for that is, like I said, we have cycles of utilities. A utility in Texas, as an example, wants to deploy, we had this, 80,000 endpoints over a 12 to 18 month time frame. They represented a significant portion of our revenue in that calendar year. They continue to contribute to revenue in a material way through recurring revenue, through ongoing support, through additional investment, but they don't necessarily show up as a top 10 utility after that deployment. So on average, the top 10 utilities, ballpark, sort of make up maybe 30-ish percentile if you average it out each year. But the number of customers that fall into that top 10 change each year. So as we think about it, and as we build out our business model and we look to execute and report, one of the attributes of our business, in our opinion, is we do not have customer concentration. And that's part of our focus on these smaller municipal and cooperative utilities. It's important for our sales team to continue to secure new accounts each year. But we're not just chasing the largest utility as a smaller organization. I had a $40 million revenue number in 2019. We're not chasing Hydro One, where all of our chips are cashed in on one utility. We've diversified our revenue profile quite substantially. And it's not uncommon where every single one of those 185 utilities, or 95% of them, are contributing to revenue every year in some capacity. We look to expand that and diversify as we continue to scale the business. So the nice news is we do not have large customer concentration. We may have it year to year, but not over a period of time.
Okay, and who owns the IP you co-create with a particular utility? Is that developmental, or is that development revenue? Can you use it for other customers?
So we retain all intellectual property. We get influence and input and direction from utilities. We have not, when I say co-created, it doesn't mean that, I guess in a few circumstances, utilities have helped fund some of our R&D over the years by purchasing things. But no, 100% of the intellectual property from our engineering team is retained and owned by Tantalus to be deployed across all customers. I'll give you an example by what I mean by that. And this is a unique attribute of, sorry, again, I'm scrolling backwards, not all that easy. Two examples for you. I'm going to use my mouse. This screen here, right over the Insight. Insight is our user interface. It then ties to this image, it ties to this image, and it ties to this image, all these software images. 4 years ago, we set off to overhaul and update our user interface, what utilities log into every day to use our system across various departments within the utility. In conjunction with doing that, we brought together a community of our users. We called them our IT advisory panel. We had representatives for several years from about 15 utilities that were strategically from different regions of Canada, the United States, and the Caribbean. They helped us map it out. We built it. We obviously own the intellectual property, but we got their influence of what was most important to them. How would they like to see it? And as we went through iteration after iteration before commercializing, we got their input. What that allowed us to do was not only be very responsive to the utility as a partner, but we built something that we knew they would be buying. And we do that similarly across other aspects of our business. The other examples I'll highlight, sorry for the cartoonish look here, but this box is what we refer to as our next generation fiber to the home collar and gateway. We actually support a number of utilities today that have a direct fiber connection to each home, or almost all homes across their footprint. And within the rural community in the United States, and I think this is going to happen in Canada as well, there's something referred to as the broadband divide. It's really surfaced with COVID-19, right? Those communities who have access to broadband, those communities who don't. It's a real gating item as we think about access to information, remote learning, remote working. And so in many circumstances, rural electric co-ops are getting access to billions of dollars from the federal government here in the United States to build out a fiber network to ensure that every home in the US has broadband access or is covered by broadband access. That's a massive, massive investment. So what we've done is we are soon to launch our next generation fiber to the home gateway. This device has been designed with and gotten input from some of our larger utilities that are relying on our previous generation for fiber to the home connectivity. And we've done it in the context of thinking through interoperability with electric vehicles, with power walls, with solar panel inverters, with hot water heaters. How do we ultimately build the next generation device, this piece of hardware that can connect to fiber for utilities who are getting access to it and have that interoperability to control and track a number of appliances inside the home? So that's another example. We got input from, amazingly, I think 5 or 6 existing customers, and then we actually met with prospective utilities that were applying for funds to access money to lay fiber. We actually got input and ideas and verification and validation from utilities that are not even yet part of our user community. It's one of the unique attributes of public power and electric cooperative utilities. They don't compete with each other. They like to share ideas, and we're one of the partners that can help do that. So, but the intellectual property, not to avoid any confusion, the intellectual property of what we build is retained by Tantalus in all circumstances.
Okay, thanks for clarifying that. So switching gears a little bit, sorry to grow you so much on one line. So EV usage will come quickly. Utilities are often considered slow to react to changes. Yeah. Will they be able to respond successfully to this demand?
Yeah, so one of the things that we also like beyond the question, and thanks for all these questions, beyond the topic of customer concentration, one of the things that we like is, and I've witnessed this now being in the smart grid sector professionally, dating really back to 2004 is when I first got involved in it from a day-to-day operational perspective, 2008. Some members of our team much longer than that. Just makes them older with gray hair. But as an aside, I've seen a number of companies somewhat be flashes in the pan of the promise of certain technology adoption. And we've witnessed it certainly on the private side where I was at BPL Global, private company, even Tantalus up until yesterday, privately held. I've seen massive dollars from the venture capital community in the US, Canada, and other regions of the world chase, right, with otherwise is supposed to be this transformation. And then lo and behold, the companies raise significant capital at astronomical valuations, and then not for their own fault, they're just ahead of the adoption curve. Then the financial performance doesn't support the valuation, company starts to burn through cash, bad things happen. So we're sensitive to that. Fortunately, I have not been part of an organization that's gone through that. We've been a little bit more disciplined in our approach. But here at Tantalus, one of the things that we're doing is we're laying the groundwork and generating revenue and positive EBITDA as that adoption curve unfolds. So it'd be foolish for me to say the adoption will happen by this date, or all utilities will have EVs and the penetration of EVs will go from 2% in the United States to fill in the blank. I just am not smart enough. If I were, I'd be doing something different with my career. But what we're doing and where we think there's opportunity for investors is we're laying the groundwork to help utilities be in a position from a device perspective, this controller, our IP, from a connectivity perspective, these devices, our intellectual property. We're laying that foundation that provides the utilities with an opportunity to make one investment and ultimately be in a position to evolve as things unfold. So we're not making a bet on the adoption rate has to happen within this time frame. We're making on a bet that this is a broader secular driver. It's going to happen over time. We know our systems are deployed for 15 years, if not longer. The example in Ontario, utility just on the other side of Detroit, right? They've used our system for 16 years. They're going to start migrating as we continue to help to work with them to our next generation solution. So they're prepared for what's happening here on the right side of this image. All the while, we're still generating revenue. We're still driving gross margin. We're still driving EBITDA contribution and not making a bet that this has to happen in order for our revenue and our business model to succeed. We're an enabler. And so what I see happening is I don't know if General Motors will really get to the elimination of all diesel and gas vehicles by 2035. But is it unrealistic to think that 15% of all vehicles sold in the United States, of which there would be a lot, in the next 5 years? It's probably not. The fact that Hummer, right, one of the grossest, nastiest, noise-consuming, carbon emissions vehicles that I've ever seen, really a military-grade vehicle that some people like to drive around on their own. More power to you if you have a Hummer, by the way. The electric one, it's pretty cool. Cadillac, whether you like Cadillacs or not, right? I mean, they're going all electric. And so at some point that adoption happens. We're the enabler for the utility, not to have to make a bet for shareholders when it happens. We're there as it happens, and we're laying the groundwork to support it and get that uplift to drive growth for our company and our shareholders.
Great. Well, I do see a few more questions, but I'm going to follow up those offline. I think it's an interesting segue into, Peter, you're recently public. You're new to the Canadian markets. A lot of investors haven't met you before. One of the things that we talked about previously is setting milestones. So you just talked about a bunch of things that you cannot control. What are 3 to 5 goals that you've set for the company that investors can track you on?
Yeah, thanks for that, Deborah, and I appreciate. We've got and while my face may be new and name may be new, the likes of a guy like George Resnick, was intrinsic in a few companies before that with success as a publicly traded company. George's name is hopefully not new to many investors. So we're trying to balance our team a little bit, but I think. To your question, there are a couple of goals we have. First and foremost is continuing to successfully transition into the public markets this year in particular. and get to a point where we are reliably and predictably delivering our quarterly financial information and making ourselves available to the investor community, hopefully through Adelaide Capital, but also to facilitate those relationships and build that level of trust. From an execution perspective, we're going to incur expenses that we otherwise did not incur as a private company. We're also migrating from one that was a Canadian-controlled private company and got the benefit of SR&ED's credits. So we've got some migration within our operating expenses to prepare for this calendar year. And I think we're very dedicated in managing our business and managing and controlling our OPEX. It's the thing we can control the most to continue to maintain this path of delivering positive EBITDA for shareholders. Because I think it's important. Right? There are times where you want to invest, and there are times at the management level where we might sacrifice some levels of profitability. But I think EBITDA, it's not a perfect measurement for cash flow, obviously, but it's an important measurement for us as a management team to be able to identify what's unfolding in our business and manage it accordingly. To that end, nobody anticipated COVID-19. No one anticipated what the disruption was. One of the greatest accomplishments we've had is still navigating through that as a management team and delivering another year of positive EBITDA through what otherwise was pretty tumultuous times for smaller companies and certainly the utility industry. So I think maintaining that vision and that ability to execute. And then I think there are a few R&D deliverables that we're going to focus on. We're talking a lot about expanding the revenue contribution from software and services, leveraging the data that we capture. And so one of the key milestones we're looking at this year are twofold from an R&D perspective. One is the actual commercialization and rollout of a momentary outage analytics tool, and getting that deployed across utilities as early adopters within our user community to help them pinpoint not only what happens when an outage unfolds, but where it's going to unfold. Where do they need to invest? The second thing is I had referenced we're working hard on getting and completing our next generation device to help utilities leverage fiber and create that interoperability. And so getting to a point where we're in production, maybe not necessarily commercial deployment, but in 2021, getting to a point where we are actively marketing and actively pursuing our next generation device to help utilities prepare for the adoption of these different resources. That's another thing from an R&D perspective that we look to deliver this year and be able to report on.
And are you offering any guidance on revenue EBITDA?
Yeah, at this point, Deborah, I think just not yet. I would expect a very, very solid growth year over year as we see utilities ramp back up after COVID-19 disruptions. And we would expect to maintain very strong gross margins and deliver positive EBITDA this year, but we're not yet providing that direct guidance. But as we get smarter about this and I think get into the market, we'll obviously do our best to provide that guidance to investors, because obviously the financial performance is paramount to people making decisions, and I'm obviously acutely aware of that. And so we'll work towards that and building a level of trust and being able to demonstrate quarter over quarter and year over year financial results.
Sounds good. Is there anything that we've missed today that you think we should touch on, Peter?
The only thing I would add, Deborah, is first and foremost, thank you and Tina and the team at Adelaide for allocating the time and assembling a group of people to learn a little bit more about Tantalus. To those of you on the phone, I hope to have a chance to interact with you and appreciate you allocating the time today to learn a little bit more about our sector and learn a little bit more about our team and what we're trying to accomplish. So thank you.
Well, thank you, Peter. I think it's a really interesting and timely story. Like we mentioned earlier, you're really on a couple trends that I think are going to be long-lived. You're an industry disruptor. You have a large addressable market. You're solving problems for utilities, which I like to see, and you've got strong financial performance and growth that you outlined. So yeah, thanks for coming on. I look forward to following the company and getting to know you and the Tantalus story a lot better over the coming months. And
Thanks, Tamara.
thanks everyone for participating. Sorry we ran a little bit over.
Thank
Have
you
a
all.
good afternoon.
You all do the same.